The Reserve Bank lifted official interest rates this month and is expected to lift them again by the end of the year. Colonial First State Head of Investment Markets Research, Stephen Halmarick, is with me today to discuss how this affects investors. Thanks for joining me, Stephen.
My pleasure, thank you.
What has the rise in interest rates meant for Australian investors in the various asset classes?
The recent increase in the interest rate from the Reserve Bank was very well signalled, I think. So we had a small increase from 3 to 3.25. And the Reserve Bank's made it pretty clear that they're going to move rates up to a more normal setting. So we think first stop for that is probably about 4%, maybe in the second quarter of 2010. But the market's already preempted that. The increase in interest rates was pretty well priced into market. So we didn't see much reaction in the bond market. And in fact, the equity market rallied on the news, and international equities rallied after Australia put rates up as a signal that the global economy was beginning to recover. So the increase in interest rates here really hasn't had a negative impact on the rest of the market.
Will this mean that more investors are likely to leave their money in cash?
Well, I think the thing there is that the interest rates are still pretty low. As I said, they're 3.25% now, perhaps going to 4%. That's still pretty low in the big scheme of things, and I think investors will be looking for a better return, perhaps in equity markets, in fixed income, infrastructure. So I think even though interest rates are now beginning to rise, and there might be some incentive to put more money into that sector of the market, other sectors are likely to perform better over the long run, given the economy is now in recovery mode.
Foreign investors, institutions and governments are likely to be seeing Australia as a very attractive place with the rising interest rates. Are you tending to see the money trickle in?
Well, I think it's less a trickle and more of a flood, actually. We've seen significant global capital inflow into Australia. Clearly, that you can see that in the Australian dollar, trading up through 90 cents. So I think the rest of the world, looking around at the global markets at the moment, Australia is obviously an economy growing much faster than the other OECD economies. Interest rates are higher, very well run, particularly the banking system. So we're seeing significant capital inflow into Australia, especially that's coming now in the form of equity. So the last 9 months, the last 3 quarters, have seen significant equity inflow into Australia, both through the new capital raisings in the market and direct investment into Australian companies.
Can you tell us how global bond markets are positioned right now and how an Australian investor might get exposure to these?
Well, 10-year bond yields in most of the other major countries, the US, UK, Europe, are around about 5.3%, 5.2% at the moment. Japanese yields are much lower, only about 1.3%. So yields in those other major economies are still pretty low. But you can get access to those markets through buying retail funds, managed funds, such as the Colonial First State funds. And you get access to those global fixed income markets by investing in a fund manager to allocate that capital for you.
What are the bond yields currently in Australia, and how does knowing these details help an investor as to what decisions to make next?
Well, of course, with the Australian economy stronger than most of the other countries around the world and official interest rates now rising, bond yields are higher in Australia than other countries. So 3-year bond yields around about 5%, 10-year bond yields around 5.3%. And I think, as I said, much higher interest rates than the rest of the world, higher bond yields. So that market looks particularly attractive.
What bonds do you see as attractive at the moment?
Well, I think the really interesting thing at the moment is the reissuing of inflation index-linked bonds in Australia. The Commonwealth Government has just issued a new 2025 maturing inflation-linked bond. It went at a yield of around about 3%. And with inflation on top of that, that looks pretty attractive over the medium term. They wanted to issue $1 billion of that bond. They got bids for $5.5 billion, and they actually ended up issuing $4 billion. And we think there'll be further issuance into that 2025 bond. So a lot of interest in that inflation-protected fixed income market.
How do I get access?
Again, you are investing through funds that are available to retail investors, including obviously Colonial First State funds, accessing that diversified fixed income market, including index-linked bonds.
So where do you see the Australian dollar moving from here?
Well, as we said, that significant global capital inflow has really been pushing the Aussie dollar up quite strongly, back up through 90 cents. And I think that the rest of the world's looking at Australia, where interest rates are going to rise and the economy is doing particularly well, and seeing us as a good place to put their money. And it's hard to think of reason why that's not going to continue for a while. The other part of the story, of course, is weakness in the US dollar and weakness in other currencies such as the pound sterling. And so Australia is doing quite well against both those currencies.
Do you think it will achieve parity with the US dollar?
If you look at Australia over the medium term, particularly given our resources and our link to China, you would have to think that there's still some upward pressure on the Aussie dollar, particularly in an environment where the US dollar might weaken further. Whether that means we get above parity, I'm not too sure, but certainly the Aussie dollar does look like it's going to be pretty well supported over the next few years.
Thanks very much for your time today, Stephen.
My pleasure, thank you.